Is Treasury quietly executing Miran's goal to FX playbook? We have compelling evidence of a stealthy U.S. FX reserve accumulation using gold. Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on Tuesday, May 6th, recording at 11:12 a.m. While we are watching another stunning rally in the gold market and a lot of interesting things happening beneath the scenes that would account for said rallies that we are seeing. And uh, interesting, I said another stunning rally. I wonder, have we gotten to the point yet where you wake up and gold is up 50 or $100 and it's like, okay, gold's up quickly, how that has changed. So in either case, we do have another $80 day that has brought the gold futures over the $3,400 level at 34.03 and makes some of those past sell-offs feel like a distant memory. And here we see that was after reciprocal tariffs, dipped below 3,000, got over 3,500. Then below, did we get? Yes, we did get underneath 3,200 briefly, I believe. And then now back over 3,400. So whether we like it or not, I am anticipating continued volatility like this because obviously it's one thing if the price is just moving, but when you factor in the context within which it is moving, as we will certainly do in today's show, then I'm not sure there's an immediate path where we go back to 5 or 10 or $20 is a big day. So anyway, over 3,400 again. And we also have silver on the move, another 6/10 of a penny away from 90 cents up on the day, which has brought us back over the $33 level. Still a little bit a ways, over $2 away from the high earlier this year, which you see down here at 35.49. So, as we have talked about in recent weeks here on the show, really, I think the big difference between silver and gold right now is that you've had a lot of money going into gold, whereas silver, where the US is the dominant marketplace. That's right, stackers. The US retail, in 2023 was about half of the investment silver market because there was so much selling last year and the retail figures were down, was a third last year. But whereas gold is right now being used in a different capacity more internationally, the silver investment it's interesting. When I went to Argentina last month, even where they've had hyperinflation several times in the past few decades, buying gold and silver is not a thing. So when US retail silver is not buying as much, at least from the investment perspective, that factors in. And which is not to say that I would go sell your silver, because in silver's favor, obviously we're not there yet, but conditions in place that would seemingly put us on track to make a shortage possible at some point. And we won't dig into all of that today. Although with all that said, that's why you have gold a lot higher, where, and underlying all of this and what we're about to dig into in a moment in terms of how the government may have been involved in the gold market again, underlying all of this is that if the US Treasury stops being able to be a functional store of international value, which you could say we're either have reached that point or are close to that point, certainly on track for that point. And if that money flows into gold, well, that's what we've been seeing. Interesting to think, are we at the beginning of a bigger shift, which, based on the global debt markets, you would almost think that's at least reasonable to factor in some probability. Interesting to imagine if we're in the first inning of this, which I won't sit here today and say conclusively that we are, although I've been thinking about that a bit more, and we will get to exactly why. Quick look at the dollar index, which is down a bit today, a third of a percent, back over 99, but still on the lower end of its recent range, and not too much happening in the bond yields, where been somewhat steady after that wave of selling and then buying and then selling right after the reciprocal tariffs were announced. So quick look at the 3-month chart. You can see here we were yields. And once you get to that 5 level or close to it, It's when you watch the MOVE index, which you can find on TradingView, essentially the VIX of the bond market. Once you get near that 150 range, that seems to be when government officials get concerned. So we will keep you posted on that. But now into the main action of the show, because over the weekend I was reading Luke Groman's fantastic column, which I would love to show more, although it's behind his paywall, and do want to respect that. Although I think you probably have heard me say before that I'm a big advocate of his work and research, and also think he's just a really cool guy. And we'll be reaching out to see if we can get an interview with him soon. Although one of the things that he highlighted was a tweet from hedge fund manager named Michael McNair that came out last week. And Luke was saying essentially, are we seeing a form of gold QE in effect? Certainly pretty intriguing. And again, I don't know that there's enough. I won't sit here and say this is conclusively what's happening, but also wouldn't sell the put at zero on that one either. So let's take a look at this message from Michael McNair. And I'm going to read through the whole thing. It's not terribly long, but quite worthwhile. So there you got a little snippet of how long. And here we go. Is Treasury quietly executing Miran's gold to FX playbook? We have compelling evidence of a stealthy U.S. FX reserve accumulation using gold. Stephen Miran's 2023 user's guide detailed, and by the way, I will link to that user's guide. This is this one here. 41 pages. Fascinating stuff, though. And if you want to go through that, in the description field below. And that user's guide detailed how Treasury could convert gold into foreign reserves without congressional approval. Current market fingerprints suggest Miran's playbook may already be active. How his strategy works: buy unlimited gold. Treasury under 31 USC 5116 can acquire bullion freely without new appropriations, typically financing via short-term T-bills. Gold is the only asset Treasury can later monetize into foreign cash without new appropriations. Monetize gold later. The Gold Reserve Act requires proceeds from gold sales to retire Treasury debt. Create a debt liability first. ESF, the Exchange Stabilization Fund, sells dollars forward. In other words, agreeing to deliver US dollars in 6 months for euros. Next, they settle using gold. Just before settlement, the Treasury sells gold, immediately using the dollars raised to retire the forward liability from that swap that they just mentioned, satisfying the statutory debt reduction. Result: Treasury swapped the idle bullion for interest-bearing FX reserves, all within existing law. No congressional vote was needed, no hit to the headline debt, no directional bet on gold. That's the whole playbook. Buy gold freely and use it as collateral to flip into euros or yen via forward sale of dollars. So I understand that could be a little bit complex, certain parts, although feel free to pause this and read through it slowly if you take them one at a time. They do make sense. And although I'm not going to get too in detail into those right now, although one thing I will add before we get to the evidence it's live is that you still had all that gold and silver that came from London to the US. I don't know that the Treasury was involved in any of that. Does seem a question worth asking to Treasury Secretary Scott Goldbug Vicent, as they called him in the office. His words, not mine. So, as you'll see, Michael lays out his thoughts of evidence that's live and mentions 2,000 plus tons of gold shipped to New York since December, the largest inflow ever. Euro forward rate, essentially the 1 year forward discount versus spot. The euro US dollar rate normally tracks spot closely, but recently has diverged. And he says, see the chart below. So you can see that is the correlation. And here is where it diverged. And let's see if we can zoom in and see the month on that. So there you go. Looks like the divergence right towards the second half of February and leaving us where we are now. Then he continues, this indicates someone who is rate insensitive is supplying dollars or demanding euros in the forward market strongly enough to flatten the curve even as the cash market pushes spot higher. That is precisely the footprint you would expect if a large player were selling USD forward in size while simultaneously accumulating euros. Forward supply leans on basis forward points, but the spot legs of these trades, whether outright euro buys or the mirror leg of a gold swap, push spot up. In other words, the correlation break is further circumstantial evidence that the forward leg is being used to fund something structural, not a speculative punt. Number three, last week, Treasury abruptly raised its Q2 borrowing estimate by 390 billion, primarily in short-dated bills, precisely how you'd pre-fund a substantial forward settlement requiring cash delivery. Now, here he lays out some alternative explanations, which is one of the things that I look to, where not someone who's trying to jam an opinion down your throat, but also saying, what else could it be? And he mentions, admittedly, this theory could be explained by other factors. European institutional investors have sold large, unhedged US dollar asset holdings, pressuring spot euro US dollar upward. Massive bullion inflows to the COMEX were partly driven by tariff fears, creating a profitable ARB and prompting dealers to deliver gold against COMEX futures. I agree, there's some degree to which that could have contributed. It's an unknown, but I don't think that fully accounts for what we've seen. I also get the feeling, and I can't prove this, but it seems like Trump and Bessent have more planned or happening behind the scenes than they're letting on. Whether it's actually the explanation Michael's laying out here or not is another question, but just my opinion. It does feel to me like I hope there's another plan behind the scene, because the initial plan has not gone well. So anyway, the extra bill issuance could merely be catch-up financing to get the TGA back to 850 billion once the debt ceiling is lifted. But if Treasury were also buying bullion for a forthcoming FX swap, the mechanics would look identical on headline borrowing data. Issue bills now, which shows up as higher in net borrowing, pay bullion suppliers, cash outflows eat into the TGA, sell the gold for dollars at forward settlement. Also doesn't fully explain why the Euro USD forward curve has flattened steadily across longer maturities, nor why the forward versus spot correlation would break so decisively, nor the curious alignment with Treasury's sudden borrowing spike, and why COMEX stocks would remain persistently high after the tariff exemption. They've only bled about 1.5 million ounces, small, which I have mentioned how metal has been leaving, in my opinion, to fund the gold mania that's broken out in China, although while it has been leaving, as Michael points out here, is small relative to, at least so far, relative to what went in. And he asked, why isn't the metal racing back to London now that the ARB is gone and those EFP premiums have come back down? And lastly, also important to note that public ledgers still show flat official FX assets. That means either dealer banks are warehousing the euro and yen leg until forward settlement, perfectly consistent with Miran's structure, or we're still testing the plumbing with modest ticket sizes. We should know for certain in short order, as Treasury must publish sovereign wealth fund details by Sunday, May 4th, and Thursday's H41 release and upcoming TIC banking data will confirm whether we're witnessing the first genuine US FX reserve buildup in decades, or if it's simply an improbable set of coincidences that just happen to perfectly align with the mechanics of Miran's gold reserve accumulation strategy. Again, we did have Scott Bessent a couple months back say that they were monetizing the assets on the U.S. balance sheet. Did follow that up by saying that he wasn't talking about gold. And I'm not accusing him of being dishonest, just pointing out that if it turned out that one of those statements was not true and they were doing something anyway, it would not be the first time that the government has done something like that. And anyway, just thought that this was quite interesting. I'm going to leave the link to his tweet in the description field below. Michael McNair. A lot of it, again, if you read through some of his other comments, also quite intriguing. He's not someone who just hopped out of college yesterday and thought there's inflation on the way and gold is going to go up. Clearly an accomplished guy. So just wanted to point that out again, as he phrased it, and as I'll phrase it once more. Do we know that this is happening? No, although just very fascinating to see some of the signs of what could be happening. And we will continue to explore those possibilities and I'd like to think that I phrased it in an appropriate way here today. Again, here is the paper by Stephen Miran, which I will not read. I won't read through this one today. That would take a little while, although here you can see some of the things that he covers. And if you found Michael's comment interesting, and especially if you like digging deeply into not just what's being speculated, I mean, here, Stephen Miran, currently serving as chair of the Council of Economic Advisors to the Trump administration. So, in that position, and wrote out what he would advocate. So, I will let you connect the dots on that as you will. And by all means, leave a comment below if you have any thoughts on that one. And I will continue to investigate that. Can keep in mind that this is going to continue to unfold at a time when now everyone's favorite CEO, Jamie Dimon of JP Morgan, told investors last week that the best case outcome for the US is now a recession. And he's saying that, especially in reference to the trade war. So, divergent from what Jerome Powell has continued to say about how the economy is strong and they're going to bring inflation down by lowering interest rates. And we'll see how that goes. Paul Tudor Jones says stock market will hit new lows even if Trump cuts tariffs to 50%. And now, in addition to the Fed's own projections in their dot plot, as well as the futures market pricing, even the CNBC survey thinks that Jerome's going to be cutting later this year. And I would imagine they will be right. So, anyway, just wanted to pass that along today. And before we wrap up, also would like to thank First Majestic Silver, who was our kind sponsor for today's show. And First Majestic, following their deal with Gatos Silver in the first quarter, produced 7.7 million ounces of silver equivalent. And here you can see the breakdown. That came to 3.7 million ounces of silver, 36,469 ounces of gold, 12.5 million pounds of zinc, 7.5 million pounds of lead. And First Majestic will be releasing their earnings tomorrow, May 7th, after the close. So will be interesting to get more information from them, especially now as they've incorporated Gatos into their operation. And certainly with the current gold and silver pricing helping out quite a bit. So you can find out more at firstmajestic.com. And again, their earnings will be out after the close tomorrow. So going to wrap up for now. Thanks as always for tuning in, and I'll see you again soon.